How to Profit in a Recession, the Elite Strategy Guide. While the masses panic during economic downturns, the wealthy see opportunity. Welcome to Luxona. Today, we're revealing how economic contractions have created more millionaires than any bull market in history. What separates those who prosper from those who perish during recessions isn't luck or timing. It's strategic foresight and financial discipline. The principles I'm about to share have helped the elite not only survive, but thrive during the most challenging economic periods. These aren't complicated tactics requiring insider access. They're timeless wealth principles that anyone with discipline and vision can implement. As history has repeatedly shown, fortune favors the prepared mind. Let's ensure yours is ready. 1. Eliminate debt, the foundation of recession-proofing. The single most important step to not just surviving, but profiting during a recession is eliminating debt. This isn't merely about financial mathematics, it's about freedom. When economic storms hit, those with debt payments become servants to their obligations, while those without debt become masters of opportunity. Your first priority must be eliminating all consumer debt. Credit cards, auto loans, personal loans, anything with an interest rate attached. These are not assets, they're anchors that will drag you under when tides shift. Next, build toward eliminating even good debt, like mortgages. While conventional wisdom celebrates leveraging other people's money, true wealth builders understand that leverage works both ways. It multiplies gains in good times and magnifies losses in bad. Remember this principle. Those with no debt payments can deploy capital when others can't. While the debt-burdened are servicing loans, you'll be servicing opportunities. 2. Build your fortress, the emergency fund imperative. Before investing a single dollar in recession opportunities, you must establish your financial fortress, the fully funded emergency fund. The standard 3-month emergency fund is inadequate for recession-era opportunity seeking. 6 months of expenses is the minimum. 12 months is optimal. This isn't just about security, it's about psychological freedom. When you have a year's worth of expenses, liquid and accessible, you operate from a position of strength rather than fear. You can make rational decisions while others react emotionally. You can hold investments when others are forced to sell at losses. Keep this fund in high-yield cash instruments, not invested in market securities. The purpose isn't growth, it's stability and accessibility. Remember, cash is king in recessions, not just for survival, but for acquiring discounted assets when others are desperate to sell. 3. The opportunity arsenal. Positioning for acquisition. With your debt eliminated and your fortress built, it's time to create your opportunity arsenal. Dedicated capital positioned for strategic acquisition during market downturns. Unlike your emergency fund, this capital is specifically designated for investment opportunities that emerge during economic contractions. This should represent 20 to 30% of your investment portfolio, gradually built during stable economic periods. The wealthy understand that recessions follow predictable cycles. They're not random catastrophes. They're inevitable phases of economic evolution. By positioning capital before these cycles complete, you place yourself among the few prepared to act when values plummet. This capital should be kept liquid but growth-oriented during pre-recession periods. Treasury bills, short-term bond funds, and conservative dividend stocks provide both growth and accessibility. When others see their investment options disappearing, you'll see your opportunity window opening. 4. The assets that flourish in downturns. Not all investments perform equally during recessions. The elite focus on specific assets with historical resilience and recovery potential. Quality real estate. Property values inevitably decline during recessions, creating acquisition opportunities at 70 to 80 cents on the dollar. Focus on residential properties in stable neighborhoods with strong rental demand. Cash flow becomes paramount. Each property must produce positive monthly income, even with conservative occupancy rates. Dividend aristocrats. Companies that have increased dividends for 25+ consecutive years demonstrate exceptional business models and management. These stocks typically decline less during downturns and recover faster during upswings while paying you to wait. Essential business services. Companies providing non-discretionary services, healthcare, utilities, basic consumer goods, maintain demand regardless of economic conditions. Their stock prices may temporarily decline, but their business models remain intact. Self-improvement. Your greatest appreciation potential isn't in external assets, but in yourself. Invest in skills that generate income regardless of economic conditions. Sales ability, digital marketing, financial analysis, these skills command premium compensation in all environments. Remember, the goal isn't to time the market perfectly, but to acquire quality assets at substantial discounts to intrinsic value. Fifth, the psychology of recession. Profiting. Financial success during recessions is 20% strategy and 80% psychology. You must train yourself to act contrary to prevailing sentiment. When headlines scream catastrophe, your mindset must remain calibrated to opportunity. When friends and family question your sanity for investing, your conviction must remain unshaken. This psychological fortitude isn't innate. It's developed through preparation and education. Study previous recessions. Understand their causes, durations, and recovery patterns. Knowledge transforms uncertainty into calculated risk. Create a written investment policy statement before market turbulence begins. Detail exactly what conditions will trigger your buying activity and what assets you'll target. This prevents emotional decision-making when fear permeates the atmosphere. Remember, the masses make decisions based on current feelings. The wealthy make decisions based on historical patterns and future projections. 6. The accelerated wealth timeline. Recessions compress wealth-building timelines for the prepared. Assets that might take decades to acquire during economic expansions become available at dramatic discounts during contractions. Consider this. A 30% market decline means you can acquire 40% more ownership of quality companies with the same capital. A 20% decline in real estate prices means 5 properties for the previous cost of 4. These discounts don't just represent immediate savings, they represent accelerated compounding trajectories. Each percentage point of discount translates to years of conventional appreciation. The wealth gap doesn't just exist between the rich and poor, it exists between those who understand economic cycles and those who don't. 7. Capitalizing on mass psychology. The final element of recession profiting requires understanding mass psychology. Financial markets are driven by 2 emotions, greed and fear. During recessions, fear dominates, creating predictable behavior patterns you can capitalize on. When fear peaks, quality assets trade at irrational discounts to fundamental value. The market doesn't discriminate between excellent businesses facing temporary headwinds and failing businesses facing extinction. This creates buying opportunities in companies with strong balance sheets. established competitive advantages, and resilient business models. The most profitable moments come when quality assets are sold indiscriminately during liquidity crunches, when good companies are dumped alongside bad simply because investors need cash. Position yourself as the liquidity provider in illiquid times. Be the solution to others' fear-driven decisions. You now possess the blueprint, followed by the elite during every economic contraction in history. While these principles may seem simple, their application requires discipline, few possess, and foresight even fewer cultivate. Remember this: recessions don't determine who gets wealthy and who doesn't. They merely reveal who was following these principles all along. Begin implementing this strategy today, not when recession headlines dominate. By then, your foundation should be built, your fortress established, and your opportunity arsenal prepared. Economic winters don't create wealth inequality, they merely reveal it. Be on the right side of that revelation. This is Luxona, where millionaires are made.